Hi friends, I am Viral Shah, Senior Instructor and Head of Investing Education with Sharekhan Education. Recently, you must have seen a lot of price movement in the defense stocks, and you might have wondered what would be the reason behind it? Well, let us take you through a brief understanding of why the defense stocks are in the limelight. The global military spending went up to $1,928 billion in CY20, registering a spending CAGR of 3.9% over CY17 to CY20. The US and China were the two largest defense spenders, followed by India. The overall growth of India went up by a CAGR of 4.1% over CY17 to 20. However, the global defense trade fell by CAGR of 10%. The US, Russia and France were the top exporters, and India was the largest importer as imports grew at a CAGR of 5%. Our country depends on foreign suppliers for most major weapons platforms in submarines, aircraft, helicopter and anti-craft systems. Owing to this overdependence on foreign suppliers, the Ministry of Defense has raised concerns over India's national security, costs, time slippages, non-availability of spare parts and products, unwillingness to transfer technology, and corruption. To address these concerns, the Government of India has announced policy shift and reforms under the Atmanirbhar Bharat scheme in the defense sector. The key initiatives announced so far include list of 210 items for indigenization, Defense Acquisition Procedure 2020, earmarking of INR 714 billion for domestic procurement in FY22 budgeted estimate, increased partnership with the private sector that led to sizable rise in exports, introduced policies for more transparency and faster decision making, reformed offset policy for attracting investment and transfer of technology for defense manufacturing, introduced a strategic partnership model for Indian companies to tap the global original equipment manufacturers to seek technology transfers in setting up domestic manufacturing infrastructure and supply chains, brought about R&D reforms, and introduced online pre-delivery inspection to address security threats. This policy shift brings opportunities for stock market investors. Within the defense sector, the subsector of defense electronics offers a huge potential market size of rupees 1.5 lakh crore in the next 4 to 5 years, led by the requirement of the armed forces for advanced systems. Defense electronics make up only 25 to 35% of the cost of platforms used by the Indian armed forces, and it will increase in the future. As indigenization efforts continue, a significant portion of electronics will be sourced locally and provides a huge opportunity for the local manufacturers of electronics. We have researched two listed companies within the defense electronics segment, both of which can benefit significantly due to the policy shift by the government, and I shall now briefly talk about them. The first company is Bharat Electronics Limited, BEL. Bharat Electronics is the largest PSU that specializes in manufacturing of defense electronics. It is one of the key beneficiaries of the government's defense capital expenditure and Make in India drive. BEL offers products and services in wide spectrum of technologies like radars, military communications, naval systems, electronic warfare systems, telecommunications, sound and vision broadcasting, optoelectronics, tank electronics, solar photovoltaic systems, embedded software, and electronic components. The company also provides turnkey system solutions like command control, communication, and computer intelligence. BEL has a competitive advantage due to its strong in-house R&D capabilities, joint R&D focus with Defense Research and Development Organization (DRDO), and preference it gets for its orders over the other defense PSUs. BEL has an order book of Rs 553 billion, which is 3.3 times trailing 12-month revenue that provides a good visibility of future revenue stream. Order pipeline stands strong from the Akash weapon system, QRSAM, LRSAM, and naval equipment like surveillance systems, radars, navigation systems, etc. Besides the orders in defense, The company also is focusing on diversifying its non-defense verticals such as EV, metros, electronic warfare, healthcare, homeland security, etc. The company's Q1 FY23 numbers have beaten the street estimate with revenue growth of 90.4% year-on-year to Rs 31 billion and EBITDA margin recovering to 16.5% on back of strong revenue growth and operating leverage. Management has given a revenue growth guidance of 15%, an order inflow of close to Rs 200 billion and EBITDA margin in the range of 20 to 22% for FY23 and exports of $70 million in FY23. At the current market price of 281, the stock trades at 24.4 times FY23 estimated earnings and 20.6 times FY24 estimated earnings. We have a positive view on the stock given the need for India to respond to its geopolitical dynamics, new orders being given out by the government, and the government of India's focus on exports in the defense sector. The stock can be bought in tranches with the first tranche at Rs 260 and the second tranche at Rs 242 based on technical parameters. Let me now talk in brief about the second stock in this sector that is on our radar, Data Patterns. Data Patterns is a vertically integrated aerospace and defense electronics provider. The company has more than 3 decades of experience providing in-house design and development for the entire spectrum of defense services such as land, air, sea and space. It provides electronic solutions including processors, power, radio frequencies and microwave, embedded software and firmware and mechanical engineering. Its core competencies include electronic, hardware, software, firmware, mechanical and product prototype design and development. It also provides functional, environment and engineering testing and validation services. The order book of Data Patterns in FY22 went up by 112% year-on-year to Rs 2,888 million, with close to 50% of new orders coming from development. The development orders grew 4 times year-on-year in FY22 and contributed to 25% of order book worth Rs 4,760 million. The majority of the order booking, close to 48%, was contributed by production orders. Although the development orders have the same gross margins as production orders, the company will use operating leverage to improve the bottom line of this business. The company expects to bid for Rs 20 to 30 billion contracts over 3 to 4 years. It expects an order inflow of Rs 4 billion for FY23 led by fire control system, that is BrahMos missile, avionics LCA, RWR fighter aircraft, LNEAT airborne and ground platform, and radar subsystems. Several orders executed are currently undergoing testing and could be scaled up, resulting in more orders in the future. It is also developing import substitutes for some products and intends to provide a value proposition through the indigenization of such products. The company is also exploring export opportunities and working on redesigning some hardware for German companies and is also in talks with a few UK companies for co-development. In FY22, sales grew 39% year-on-year to Rs 3,109 million with EBITDA growth of 53.3% and an EBITDA margin of 45.4%. Profit after tax stood at 940 million. With a healthy order book, the management expects to deliver growth in revenues of 25 to 30% in FY23 with EBITDA margins of more than 40%. Although the company is facing semiconductor and electronic component supply chain issues, it has managed the challenge by following. First, upstocking and advancing procurement of key raw materials nearly a year ahead of time, and 2, redesigning some components with available materials and standardizing more hardware. The company has good operating cash flow, a net zero debt status, healthy return ratios over 20%, and an improving working capital cycle. The company incurred a capex of Rs 380 million in FY22 towards expanding its existing facility and plans to incur 600 to 700 million in FY23 towards SMT line expansion and improving test infrastructure. At current market price of 833, the stock trades at 38.3 times FY23 earnings and 30.6 times FY24 estimated earnings. We have a positive view on the stock. On a technical basis, rupees 750 would be a good level to enter the stock. We believe that the defense sector presents a mega theme that investors can ride, given that the global defense expenditure is expected to grow to $2031 billion by 2025 due to increased geopolitical uncertainty and policy reforms by the Indian government. There is a structural shift in the defense budget with increased allocation for modernization funds and approval of non-relapsable funds. The fund available to the defense industry participants from FY22 to FY31 is estimated at INR 26 trillion. We believe that the long-term investors should ride this mega trend and can maximize the return on investment by entering at reasonably good levels. All in all, an increasing addressable market and high growth in earnings can lead to a multiple re-rating for the sector. And that's all for the day. This is Viral Shah signing off. Happy investing. This should not be treated as a recommendation. Please conduct your own analysis or consult a financial advisor before investing.